Can peace between Iran and America make you money? Gold, oil, and investing strategy for beginners. Hello everyone, this is Sam and I am your financial advisor. Welcome back to the Income Engine. Today, we're discussing a very important topic that has the potential to affect global markets, gold prices, oil prices, stock markets, and even your personal finances. Imagine a situation where Iran and the United States officially end their conflict, sign a peace agreement, and tensions in the Middle East significantly decrease. Many investors immediately ask one question: what happens next, and how can I make money from it? In this video, we'll explore how a peace agreement could impact the global economy, what might happen to gold and oil prices, how stock markets could react, and most importantly, how a beginner with as little as $100 could potentially position themselves to benefit from these market movements. Make sure you watch until the end because I'll also share some common mistakes that destroy beginner accounts and prevent people from growing their wealth. First, let's understand why a peace agreement between Iran and the United States would matter so much. The Middle East is one of the most important regions in the world when it comes to energy production. A large percentage of global oil passes through the Strait of Hormuz, a critical shipping route. Whenever tensions rise in this region, investors become worried about disruptions to oil supplies. These concerns often cause oil prices to rise because traders anticipate shortages or transportation problems. At the same time, investors often rush into safe haven assets such as gold because they fear economic uncertainty. Now imagine the opposite scenario. If a peace agreement is signed and both sides commit to reducing tensions, the fear premium built into markets may begin to disappear. Investors become more confident, businesses become more optimistic, and global markets may shift into what traders call a risk-on environment. This means money starts moving away from defensive assets like gold and towards stocks, businesses, and growth opportunities. Let's talk about oil first. Oil is often one of the first markets to react to geopolitical developments. If peace reduces the risk of supply disruptions, oil prices could experience downward pressure. More stability means more predictable supply chains, lower shipping risks, and potentially increased production from countries that were previously affected by sanctions or conflict. Lower oil prices are generally positive for consumers because transportation and energy costs become cheaper. Businesses also benefit because operating expenses decrease, allowing companies to improve profitability. However, it's important to remember that oil prices are influenced by many factors beyond geopolitics. Global demand, economic growth, OPEC production decisions, and inventory levels all play important roles. Even if peace puts downward pressure on oil prices, other factors could still cause oil to rise. That's why investors should never make decisions based on one headline alone. Now let's discuss gold. Gold is known as a safe haven asset. During wars, economic crises, and periods of uncertainty, investors often buy gold to protect their wealth. When peace agreements reduce uncertainty, some investors sell gold and move their money into higher growth investments. This can create downward pressure on gold prices. However, gold does not always fall dramatically after peace agreements. Inflation concerns, central bank purchases, and global economic conditions continue to influence gold prices even after geopolitical tensions ease. For beginners, understanding this relationship is extremely valuable. When fear decreases, gold may become less attractive in the short term, while stocks and business investments may become more attractive. Understanding where money is flowing can help you make better investment decisions. Now let's move to the most exciting question. If you have only $100, how can you potentially benefit from this situation? Before we continue, let me be very clear. Turning $100 into $10,000 is not impossible, but it is extremely difficult and carries significant risk. Many people enter the market expecting quick riches and end up losing everything because they ignore risk management. The goal should always be protecting your capital first and growing it consistently over time. Let's assume you have $100 available for investing. One approach is to divide your money strategically. Instead of placing all your money into one trade, you could spread your investment across multiple opportunities. For example, you might allocate a portion to a broad stock market ETF, a portion to technology companies, and keep some cash available for future opportunities. This diversification helps reduce risk while still allowing you to participate in market growth. For those interested in active trading, a hypothetical strategy could involve monitoring oil and gold price movements. If peace causes oil prices to decline, traders might look for opportunities to short oil during temporary rallies. This means waiting for oil prices to bounce upward and then selling when signs of weakness appear. Similarly, if gold breaks below important support levels, traders may look for opportunities to profit from continued downward momentum. However, successful trading is not about guessing. Professional traders wait for confirmation. They identify trends, support levels, resistance levels, and volume patterns before entering a trade. They also use stop-loss orders to limit potential losses. This is one of the biggest differences between professional traders and beginners. Professionals focus on risk management, while beginners often focus only on profits. Let's look at a hypothetical example. Imagine oil falls from $82 per barrel to $78 after a peace agreement. A trader notices a temporary bounce back to $79.50. If the price fails to move higher and begins turning downward again, that trader might enter a short position with a stop-loss above resistance. If the trade works, the reward could be several times larger than the initial risk. This is called maintaining a favorable risk-to-reward ratio. The same principle applies to gold. Suppose gold breaks below a major support level. Instead of chasing the move immediately, experienced traders often wait for a retest. If the price returns to the support level and fails to move higher, it may provide a more favorable entry point. Again, risk management remains the priority. Now let's discuss something many beginners overlook: compounding. Compounding is one of the most powerful concepts in finance. Imagine growing a small account consistently over time. A trader who earns modest but steady returns and protects capital may eventually achieve much better results than someone constantly chasing huge gains. The desire to get rich quickly often causes investors to take unnecessary risks. Another opportunity that many people ignore involves industries that benefit from lower oil prices. Airlines, transportation companies, logistics businesses, and travel-related stocks often perform well when fuel costs decrease. Lower operating costs can improve profit margins and attract investors. Instead of trading oil directly, some investors prefer investing in companies that benefit from lower oil prices. Let's also talk about mistakes. The first mistake is using excessive leverage. Many brokers offer leverage that allows traders to control large positions with a small amount of money. While leverage can increase profits, it can also magnify losses dramatically. A small market movement against your position can wipe out your entire account. This is one reason many beginners lose money. The second mistake is risking too much on a single trade. No matter how confident you feel, no trade is guaranteed. Professional traders understand that losses are part of the game. They focus on preserving capital so they can continue trading tomorrow. The third mistake is trading based on emotions. Fear and greed are powerful forces. When prices rise rapidly, people fear missing out. When prices fall, people panic and sell. Successful investors learn to follow a plan rather than emotions. The fourth mistake is ignoring market conditions. Just because a peace agreement is signed does not mean every market will react exactly as expected. Markets often price in information before official announcements occur. Sometimes the actual event causes less movement than anticipated because investors already expected it. So what is the best approach for beginners? Focus on education, risk management, diversification, and patience. Learn how markets work. Study charts. Understand economic events. Build a strategy and stick to it. The investors who succeed over the long term are usually the ones who remain disciplined and consistent. Remember, wealth is not built through one lucky trade. Wealth is built through good decisions repeated over many years. Whether you're investing in stocks, gold, oil, ETFs, or other assets, the principles remain the same. Manage risk, stay informed, and think long-term. If peace between Iran and the United States continues and geopolitical tensions remain low, we could see lower oil prices, reduced demand for safe haven assets like gold, and stronger performance from growth-oriented investments. These shifts may create opportunities, but they also require careful analysis and responsible decision-making. Thank you for watching today's video. I hope this breakdown helped you understand how global events can influence financial markets and how beginners can think strategically about investing opportunities. If you found this video valuable, don't forget to like the video, subscribe to the Income Engine, and press the bell icon so you never miss future videos about investing, personal finance, wealth building, and money-making opportunities.